Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. And in today's lesson, we're going to look at the financial reporting for warranties. And I will tell you to begin with what you already know, and that is that thousands of companies sell products that come with some type of a warranty. You might buy an automobile, for example, or you might buy a computer, for example, or you might buy a microwave oven, but they frequently will come with a warranty. So what we're going to do is to report how the company that makes the sale records and then reports these warranties. First off, it's important to know what a warranty is. And a warranty is nothing more than an agreement to fix or possibly replace a product if it does not work as promised. So if you do buy a car and there is a problem with the car, then the company that sold you that car is promising that they will fix it. How does that company report that warranty? The first thing that's important for you to understand is that the answer depends on the type of warranty. Many warranties are virtually contingent liabilities, and we've already done contingencies. So you already know the rules for reporting contingencies. If the loss is probable and you can make a reasonable estimation, then you have to recognize a loss or an expense and a liability. We've done that before. That's what a contingency is. Other warranties, though, are really sales transactions, and they're reported as sales transactions as revenue when the earning process or when the performance obligation has been satisfied. So we know that there's going to be two types of contingencies, and those contingencies are either going to be contingents, or those warranties are going to be contingencies, or they're going to be sales transactions. So what I'm going to do is I'm going to show you two different examples. One that's a contingency and one that is a sales transaction. So let's look at them. Here's the first one. Ace Company, and we're going to do this as an embedded warranty. As soon as you see embedded warranty, it's probably going to be a free warranty that you give away with a product. Ace Company sells 500 refrigerators for $1,000 each. That's a normal transaction. They do this on December 31, year one. The cost of the refrigerators is $400 a piece. So the easy part, of course, is that the revenue is 500 times 1,000, which is $500,000. That's your revenue. And then 500 times $400 a piece, which is $200,000, is your cost of goods sold. So we know that part. Now, here's the part that we don't know. The refrigerators come with a 1-year warranty to fix any defective part, but it comes for free. That means that if it comes for free, we typically will call this a quality assurance warranty. That just simply means that the warranty makes sure that the customer gets in working condition what the customer thought they were buying. The customer in this case, or the company in this case, believes that they're going to have to spend $8,000 to make the fixes that turn out to be necessary. Some part of these refrigerators are going to break, and the company will have to fix them, and that's going to cost them $8,000. It actually turns out that it cost them $9,000. There's nothing surprising about that. The company estimated, the company guessed $8,000. It turned out to be $9,000. It would probably be unusual if the company actually guessed exactly correct. So when a company is making an estimation on something like an embedded warranty, it or the owners or the management simply assumes that their estimation will not be exactly correct. You simply cannot foresee the future well enough to get all of the numbers lined up correctly. So what do we know? Well, we know that the revenues are $500,000. We know the cost of goods sold is $200,000. And because the warranty was an embedded warranty that was given away for free, it is viewed as a contingency. Now, remember, a contingency is a past event that's going to cause a future loss. How do you report that? If the future loss is probable, and if you can make a reasonable estimation of that loss, then you recognize it immediately by debiting an expense or a loss and crediting the liability. That's the rule on how to handle a contingency. If we assume the $8,000 is a reasonable estimation, then we're going to have to recognize that $8,000 immediately. That's it. It's not very difficult as long as it's a contingency, because it was given away for free as an embedded warranty or a quality assurance warranty. Then we're going to make an estimation and we're going to increase the expense and increase the warranty payable. So what do we report then? What we report in this situation, this is for year one only. We report the revenue of $500,000. We report the cost of goods sold of $200,000, and then we report that $8,000 contingency, which is a warranty expense. On the balance sheet, we report the warranty payable at $8,000. Now, I don't think that's all that difficult, to tell you the truth, but that's how an embedded quality assurance free warranty is handled by US GAAP. We still got one problem though. We made the guess that it was $8,000, and it turned out to be $9,000. So what do we do with that extra $1,000? Well, here's the answer. In year two, the actual cost was $9,000. We have an additional $1,000. And the rule is this: the warranty expense is reported as $1,000 in year two. You fixed it by adding the extra 1,000 into that year. So if this is year one and this is year two, then you recognize $8,000, your reasonable estimation in year one, and then you add whatever more it takes to get the right number into year two. If you can see that the warranty expense is going to be reported that way, here's your estimation, and this is what it takes to fix it. That's what you need to know about embedded warranties. As I said, I don't think this is the most difficult topic we've covered this semester. One other thing, companies rarely go back and change reported figures for an earlier year. Now you might ask, why don't you simply take this $1,000 and go back and fix the $8,000, make it $9,000? You know the right number now. It wasn't $8,000. The correct number was $9,000. So why don't you go and take the $1,000 back and change the 8 to 9? Well, in US GAAP, you rarely ever go back and change past numbers. And the reason is simple. The outside decision makers, the investors and the creditors, have already used the $8,000 to make their decision. And they would have known that that was no more than an estimation. They would have taken into consideration that it wasn't going to be exactly correct. So therefore, you can't go back in time and change the earlier decision. The earlier decision has already been made. And since the earlier decision has already been made, we don't go back and change the earlier year. We put the $1,000 into the year where we realize that it was wrong. So in year two, we realized it should have been 9 and not 8. So we add the 1,000 into year two. You can't change the earlier year, or you don't need to change the earlier year, because those decisions have already been made. There is an exception to this rule though. And the exception is that if fraud has occurred, in other words, in making the $8,000 estimation, if the company officials were fraudulent, they intended to deceive, then you do have to go back. You cannot leave fraudulent numbers on a set of financial statements. So if the $8,000 was a fraudulent number, then in that case, you would go back and change the 8 to 9 in year one. And you'll often read in the financial press where it will talk about a company that has restated earlier income numbers. That is often because of fraud. that somebody did not make a good faith estimation, and therefore, because it was considered to be a fraudulent number, it had to be changed. That's an embedded warranty. That's all you really need to know, I think. So let's go to the other type of warranty, which is an extended warranty. Ace Company sells 500 television sets for $1,000 each, 500,000. They did this on the end of year one. The cost of the television sets was $400 a piece. But this time, each customer also pays an extra $60 for a 1-year warranty to fix any defective part. If you've bought a television or a refrigerator, often the seller will ask you if you want to buy an extended warranty. Well, that's what they've done. They sold an extended warranty to the customers for $60. Ace still believes the cost will be $8,000, but it turns out to be $9,000. So this case is different because it's not a free embedded warranty. It's an extended warranty that you must pay for. So this is going to be viewed as a sales transaction. What is happening here is that the customer is buying an insurance policy. That really is what's happening as far as the legitimate fact of what occurs in this case. So how is that reported in the situation? What we do is this. In year one, of course, the sales revenue is $500,000. Cost of goods sold is $200,000. The $30,000, remember it was $60 a piece for 500 televisions, that's $30,000, is a deferred revenue. That means it's reported as a liability. And the reason it's a liability is you have an obligation to fix the television sets if they break. You have an obligation. That obligation is caused because they bought that extended warranty. When will that liability become a revenue? It will become a revenue as the work is done. It will become a revenue as the coverage of the television sets takes place. And that's going to happen in year two. So you have a deferred revenue in year one because you're going to cover the televisions in year two. So it's a deferred revenue in year one, and then it becomes a sales revenue or a warranty revenue in year two. This is a sales transaction and not a contingency. Why is it a sales transaction? Because they paid you $60. If they paid you $60, this is not a contingency in any way. It's a sales transaction with the work to be done in year two. If you get the money in year one, but do the work in year two, it's a deferred revenue rather than an actual revenue. There's no reason to recognize a warranty expense because there's not a contingency. You're handling it like a sales transaction. And when a sales transaction, you'll record the expenses when they're incurred, which is going to be when the televisions break in this case. So you have a different type of warranty and you have a different type of reporting. It's a sales transaction. For that reason, when we go to year two, you have 500,000 sales revenue for the televisions. You have cost of goods sold of 200,000, and there is no warranty expense at all recorded. Why not? Because it's not a contingency. It's a sales transaction where the work is going to be done in year two. So to show that amount of revenue that you're going to recognize on the balance sheet, under the liabilities, you'll record a deferred revenue of $30,000. What's going to happen to this deferred revenue? It's going to move into a revenue account when the work is done, and the work is done when you cover the televisions or fix the televisions in year number two. So that's your reporting for year one. What then happens is in year two, you're going to recognize the revenue because the work is done in year two. You fix the television or cover the televisions. Since the work is recognized in year two, the expense will be also. So you're going to have a warranty revenue of $30,000. You move it from deferred revenue into warranty revenue, and the expense is not $8,000 because you've never estimated it, The expense is the actual amount that you spend. And according to the problem, you spent exactly $9,000. This is not a contingency. This is a sales transaction. So whenever you have a warranty, it can be an embedded warranty or an extended warranty. The embedded warranty is a contingency. The extended warranty is a sales transaction. Now, I know that you may not have ever thought about this before now, but if you're looking at a company that sells products and gives a warranty, it's important for you to understand how those warranties are reported. My name is Joe Hoyle. I'm one of the co-authors of your financial accounting textbook. I think this is another good example of how accounting rules help you understand what is happening to a reporting company. And I think that as we go through all of these chapters, the amount of your knowledge will increase every single time you work a problem or watch one of these videos. Go for it. Learn all you possibly can so you can be a great decision maker.